Welcome to the deep dive. Today, we're really digging into something important, a big shift happening in forest conservation and the voluntary carbon market.
That's right.
We're focusing on REDD plus projects, the ones meant to help protect forests. And there's this key analysis from Abatable dated May 20th, 2025.
Yep, I've seen that one.
And it points to something pretty major.
Yeah.
A new floor price, a minimum price for REDD plus credits if they're going to be high quality.
Exactly. The whole voluntary carbon market, the VCM, it's really trying to boost its integrity right now. There have been issues.
For sure.
And REDD Plus has been, well, right in the middle of that discussion. So this analysis looks at, okay, what happens when you apply these genuinely higher standards? And it suggests the economics of forest carbon are changing. Big time.
And that core finding, it's kind of stark, isn't it? Abatable is saying the absolute minimum price for one of these high-quality REDD plus credits under the new rules, it's got to be at least $15.
To $15, yeah. That's quite a leap from where things have been trading, especially for some of the older credits.
It really is. So our mission today is to figure out why. Why this $15 floor?
Yeah.
What's really driving this push for better integrity in REDD plus fine?
And just as crucial, what does this higher cost actually mean for the projects themselves? The ones on the ground trying to protect forests using this carbon finance, can they survive?
Right. It's about trust, but it's also about the real-world financial viability.
Exactly. Rebuilding trust has a cost.
Okay, so let's rewind a bit. Remind us what REDD plus projects are fundamentally about, and where did the credibility problem start?
Okay, so REDD plus, the basic idea is to reduce emissions from deforestation and forest degradation. That's the REDD bit.
Right.
And the Portavilla is about conservation, sustainable forest management, boosting carbon stocks. Essentially paying people, often local communities or landowners, not to cut down trees that were, likely to be cut down otherwise.
Seems sensible. Good for the climate, good for biodiversity. So what went wrong? Why the skepticism?
Well, the main sticking point, and honestly where a lot of the criticism came from, was setting the baselines.
Ah, the baseline. How much forest would have been lost without the project?
Precisely. And the problem was, in quite a few cases, the assumptions about how much deforestation would have happened were, let's say, optimistic. Inflated, really.
So projects were getting credit for stopping deforestation that maybe wasn't actually going to happen at that scale anyway.
That's the core issue, over-crediting, and that seriously damaged confidence in the whole market. Buyers got wary, especially of REDD plus credits from, older projects.
Okay, so the market needed a fix. How are they trying to restore that trust? This analysis seems to bet big on new methodologies.
Yeah, that's the key. Standard bodies, like Vera, they've been working really hard on stricter rules. And the Abatable analysis highlights Vera's VM00008 methodology, launched in 2023, as a really good example of these higher standards.
VM00048. Okay, what's different about it? What are the specific changes that tackle those baseline problems we just talked about?
VM00048 introduces some pretty critical updates. First, it makes projects use jurisdictional deforestation risk maps. So instead of just looking at the project's little patch, it uses data for the whole region, the whole jurisdiction.
Wider view. Got it. What else?
It also shortens the baseline period, how long that initial estimate is valid for, down from 10 years to 6. So more frequent reality checks.
Okay, wider view, more frequent checks. But I heard there's one change that's the real game changer.
Oh, absolutely. This is huge. VM00048 takes away the project developer's ability to kind of set their own baseline using their own models or assumptions.
Really? So who sets it then?
It mandates using independent, high-quality data service providers. These providers supply standardized, jurisdiction-wide historical deforestation data.
Ah, so everyone in that region uses the same independent data, the same method, no more project-specific guesswork.
Exactly. It standardizes everything using historical data for the whole area, maps it out spatially, figures out the likely rates. It just boosts transparency massively and really cuts down the opportunity for those optimistic baselines. It's much more conservative, much more data-driven.
Sounds like they're really trying to slam the door shut on those old loopholes.
That's definitely the intention. Control the baseline, standardize it, make sure the credits represent real additional emissions cuts. But there's a consequence to that.
Which is?
Well, because VM00048 is more conservative, because it uses more realistic, often lower deforestation rates to start with, it means projects are likely going to get fewer credits issued compared to the old methods. Sometimes substantially fewer.
Fewer credits. Okay, how much fewer? Does the analysis hazard a guess?
It does. And it varies quite a bit, depending on the region's actual deforestation history. But their models suggest the emissions avoidance estimates could be anywhere from 30% up to maybe 90% lower under VM00048.
Wow, 30 to 90% fewer credits generated by the same project. That's enormous.
Did they show an example? I think I saw something about Brazil.
Yeah, they did. They compared some old project baselines in places like Pará or Mato Grosso with what VM00048 would likely estimate for those same areas. And it really shows just how ambitious some of those older baselines were. VM00048 forces a much more grounded starting point.
Okay. Stricter rules, more accurate baselines, fewer credits per project. That covers the integrity angle. Now, the money, what does this mean for the actual cost of getting these projects off the ground?
Right, and this is where the Abatable analysis really gets down to brass tacks. They modeled the cost for a typical project, say 50,000 hectares in Pará, Brazil, but using this new VM00048 methodology. What does it cost to actually do this?
And what did they find? What's the price tag per credit just to develop it?
Their modeling for that example project showed development costs per credit issued under VM00048, landing somewhere between $6.70 and $15.20. Hold on. $6.70 to over $15 just to develop and verify one credit before it's even sold.
That's the finding, yeah. And here's the kicker, the crucial point the analysis hammers home. Compare those development costs, $6.70 to $15.20, to what credits are actually selling for on the spot market right now.
Okay, what were those numbers again?
End of Q1 2025, the median price for a Brazil REDD plus credit was about $2.50. $2.50. The general market median spot price was maybe $3.50. And those older credits, the ones with the questions, they're often trading between $2 and $6.
Wait, the cost to produce a new high-integrity credit is like $7 to $15, but the market's paying maybe $2.50 to $3.50 on average. That's not sustainable.
Not even close. The analysis basically says at current spot prices, a project using VM00048 cannot be profitable. The development cost is 2 to 6 times higher than the selling price. The math just doesn't work.
Okay, so if projects are losing money at current prices, what price do they need? What does the analysis say is required for a project to actually be, financially worthwhile?
That was the next step in their modeling. What price does that hypothetical project need to hit to be attractive, to give a decent enough return on investment, say something like a 2x ROI, to make the risk and effort worthwhile?
And what was that number for that sort of realistic, viable scenario?
You get to that point, that benchmark of financial attractiveness under VM00048. The credit price needed to be over $15 per unit.
Over $15. So that's where the $15 floor comes from. It's the bare minimum to make the project economics potentially work under the new rules. What about attracting, bigger institutional money?
Right, because institutional investors often need higher returns to justify the risk. For that level of attractiveness, the analysis suggested prices would need to climb over $35 per unit.
$35, okay. But that $15 number isn't just pulled out of thin air. The analysis is saying it's the new minimum floor price, the absolute baseline for viability, based on the real costs and necessary returns when you use these better methodologies like VM00048. It's the cost of doing REDD plus right.
Pretty much. It's the price needed to shift a project from being fundamentally unprofitable today to being potentially investable.
So what happens if the market doesn't catch up? If prices don't consistently hit that $15 plus mark soon, what's the future for REDD plus mark?
Well, the analysis is pretty clear. If prices don't rise significantly to reflect these higher integrity costs, a lot of projects might just fail. Become unviable. We could see a major shakeup, maybe even a shrinking of the REDD plus sector as we know it. It's a really critical point.
Are there any glimmers of hope? Any signs the market is starting to differentiate and pay more for the good stuff?
There are some encouraging signs, yeah. We mentioned the older credits are stuck low to $6, right?
Right.
Often due to those integrity concerns.
Right.
But the analysis does point out that newer credits, when seen as high integrity, are fetching better prices. They're seeing trades in the $10 to $16 range already.
Okay, $10 to $16. That's getting closer to that floor.
Exactly. And projects under standards that are favored for compliance uses, like the RT standard for aviation, they're apparently reaching $20 or even more.
So that does suggest buyers will pay a premium when they're confident about the quality and the integrity.
It certainly looks that way. And another interesting point they make is about forward curves, prices for future delivery. They seem to show the market is starting to price credits differently based on the methodology vintage. Like, is this old style or new, high integrity VM00048 style?
That's promising. But it sounds like a big universal shift is still needed. If that $15 plus price doesn't become the norm across the board, how else might REDD plus projects have to adapt or evolve to survive?
The analysis lays out a few possibilities. One path could be a geographic shift. Project developers might increasingly target regions with genuinely higher verifiable deforestation risk, the places identified on those Vera-risk maps. The idea being, if the risk is higher, the avoided emissions per hectare might be greater, maybe helping the economics a bit.
Makes sense. What about project types? Anything different there?
Yeah, maybe we see more smaller, community-led projects. They might have lower upfront capital needs, and they often come with strong social benefits, biodiversity co-benefits, high ESG value.
But those need careful handling, right?
Absolutely. The analysis really emphasizes the need for robust, FPIC-free, prior, and informed consent and really solid governance to make sure benefits flow properly to the communities. That's critical.
And what about how they're funded?
Blended finance looks set to become much more important, using philanthropic money, ready debt for nature swaps, concessional capital, things like that to bridge the gap for projects that are really important ecologically but maybe struggle to be fully commercial solely on carbon prices, especially if prices stay lower.
Could they mix REDD plus with other activities like planting trees?
Definitely. Integrating with ARR, that's afforestation, reforestation, revegetation, could be a model.
Yeah.
You might have hybrid projects where the REDD plus part, avoiding deforestation, generates income sooner, while the tree planting part builds carbon stocks over the longer term.
And geographically, besides just higher risk, any other trends?
Well, maybe more diversity. Spreading projects to regions where implementation costs are simply lower. But, and this is a big but, that totally depends on having those reliable jurisdictional risk maps and the underlying data available for those areas. And that data infrastructure isn't everywhere yet.
Right.
That's a major bottleneck.
Okay, so let's bring this home. For you listening, whether you're deep in the carbon markets or just someone who cares about climate action, why does this wonky stuff about methodologies and floor prices actually matter?
It matters hugely. This shift directly impacts the future supply of carbon credits. Are there going to be enough credible credits to meet demand? It affects whether these vital forest conservation projects can actually continue their work.
Yeah.
And for anyone buying credits, it fundamentally redefines what high quality means. It sends a clear signal. If you want to support real impact, verified impact, you need to be prepared to pay more for it. It's about acknowledging the true cost.
Right. It's understanding that doing this properly, measuring, reporting, verifying, avoided deforestation, using these robust, less gameable methods, it just costs more than the old, looser way.
That's really the crux of it. The market pricing has to catch up to the cost of integrity if RDD Plus is going to deliver on its potential.
So to wrap up our deep dive on this abominable analysis, this move towards higher integrity in REDD plus using tools like VM0048, it's absolutely necessary to rebuild trust, no question. But as the analysis makes crystal clear, that integrity comes with a significantly higher price tag. It changes the whole financial equation.
And that key number, the one takeaway figure, is that $15. For these new high-integrity RDD Plus projects to be viable, buyers need to expect and be willing to pay a minimum of $15 per credit. That's the new floor.
And the massive uncertainty, the big question now is, will they? Are buyers really ready consistently to pay those higher prices? That answer, plus getting that crucial jurisdictional data rolled out everywhere, that's what will shape the future of REDP Plus.
Yeah, it's more than just a price point. It's about finally putting a more realistic value on keeping forests standing, which, let's remember, when done right, is arguably one of the most powerful and cost-effective climate solutions we have.
So maybe the final thought for you is, what does this necessary price hike really tell us about the true cost of high-integrity climate action? And what role do you as a buyer, an observer, just an informed citizen, play in deciding whether REDD Plus finds this needed redemption and proves it can deliver on its promise?
Definitely food for thought as this market continues to evolve.